If you printed money in your basement, federal agents would kick down your door within weeks. You'd face 20 years in prison for counterfeiting, yet banks do exactly this legally every single day. They create 97% of all money in the economy. Not the government, not the Federal Reserve printing presses, private banks generating currency from nothing. What if the entire monetary system is the largest counterfeiting operation in history? What follows isn't theory. It's documented and admitted, hidden in plain sight within the banking system's own manuals. You're about to see how money really works. Once you understand, you'll never look at your bank account the same way again. If you want to know what's really happening to your money, subscribe to the 97th percent now. You won't believe what comes next. The system depends on you believing a comfortable lie. Governments want you to think they control money, that elected officials manage the currency in your wallet and the digits in your account, that democratic oversight protects the money supply. But it's a fabrication. Governments produce just 3% of money as physical cash. Nearly all of it exists only as numbers on screens conjured up by private banks. The Federal Reserve admitted this openly for decades. A booklet called Modern Money Mechanics, published by the Chicago Federal Reserve, explains the process in plain language. Banks don't lend money they already have. They create new deposits by issuing loans. The document stated it clearly. Banks build up deposits by increasing loans and investments. Not banks lend out deposits, they generate deposits through lending. Money appears the moment you sign a loan agreement. This was official Federal Reserve educational material, available to anyone who requested it. Then in 1994, the Fed quietly discontinued the booklet. No explanation, no replacement. The manual that explained how banks actually create money simply vanished from circulation. Why eliminate a document that educated the public about monetary mechanics? What changed that made this information suddenly too dangerous to distribute? The Bank of England confirmed the same process in a 2014 report, stating that when a bank makes a loan, it simultaneously creates a matching deposit in the borrower's account, thereby creating new money. Central banks worldwide acknowledge this, and yet the myth persists. Politicians debate government spending as if Congress controls the money supply. News anchors discuss the Fed printing money as if physical currency matters. Financial advisors tell clients to save dollars without mentioning those dollars are someone else's debt. The system functions because most people never question where money actually originates. They assume government oversight means government control, but it doesn't. What looks like a glitch in the system isn't a flaw at all, it's the entire design. Fractional reserve banking once allowed banks to lend out $10 for every $1 held in deposits. Your grandmother deposits $1,000 and the bank can issue $10,000 in new loans. The money doesn't exit anywhere, it materializes as digital entries when the bank approves the loan. Then, in March 2020, during the chaos of the pandemic, the Federal Reserve did something unprecedented. They eliminated reserve requirements entirely. Banks now operate with zero mandatory reserves. The 10-to-1 ratio that once governed money creation is gone. The theoretical limit on how much money banks can generate was abolished. This isn't speculation, it's official Federal Reserve policy, buried in a press release that received almost no mainstream coverage. The multiplication works like this. A single deposit cycles through the banking system, spawning loan after loan. Each loan generates new deposits. Those deposits enable more loans. Money expands geometrically through the financial system with no legal ceiling. Borrowers owe real debt for numbers that appeared with a keystroke. This sounds exactly like fraud. If you tried it as an individual, you'd face prison. Yet banks operate this way legally, protected by regulators and defended by economists as necessary policy. A legal system that imprisons individual counterfeiters protects institutional counterfeiting on an unimaginable scale. Which corporations receive newly issued capital? Which industries expand and which ones starve? These decisions shape the economy more than any vote you'd ever cast. Elected officials debate government budgets while private banks generate money without limit. The public argues about tax rates while the real money supply expands invisibly through debt. The system requires perpetual growth because yesterday's loans must be repaid with tomorrow's newly issued money. Creation is only half the trick. The devastating part is who gets the money first. In this system, the money flows upward. The first people to receive newly created currency hold an invisible advantage over everyone who comes after. Economists call this the Cantillon effect, named after an 18th century banker who first documented the pattern. When banks issue fresh money through lending, it doesn't spread evenly across society. It moves in a specific direction, enriching early recipients before prices adjust to reflect the expanded supply. And banks decide who receives this new money, not randomly, not democratically either. They lend predominantly to corporations with established credit lines, hedge funds with existing portfolios, and investors who already control substantial assets. These first spenders purchase property, stocks, and commodities at yesterday's prices. By the time your wages increase to match inflation, asset values have climbed beyond your reach. The 2008 financial crisis revealed this with fierce clarity. When the system collapsed, the Federal Reserve conjured trillions in emergency liquidity. That money went to the financial institutions first, not to homeowners facing foreclosure, not to workers losing jobs. The banks themselves received freshly issued capital while millions of Americans lost their homes. What happened next was the largest wealth transfer in modern history. Foreclosure auctions became feeding frenzies for investors with access to cheap credit. Blackstone Group, the private equity giant, spent $10 billion purchasing nearly 50,000 foreclosed homes between 2012 and 2016. They bought entire neighborhoods at Depression-era prices, then rented those same houses back to the families who'd lost them. The pattern repeats with every monetary expansion. New money benefits those closest to the source, asset prices climb, each cycle consolidates more wealth in fewer hands. Central banks acknowledge this in their own documentation. They frame it as necessary monetary policy rather than what it actually is: systematic wealth extraction from the many to the few. The math is simple. While the money supply expands 7 to 10% annually through bank lending, wages grow roughly 3%. You fall further behind with every passing year. Housing reveals the cage most clearly. Mortgage loans materialize when banks approve applications. Purchasing power magic kit into existence. This manufactured credit floods the housing market, inflating prices far beyond what incomes can support. The national average now sits at 5 times annual household income. In coastal cities like Los Angeles and San Francisco, the ratio climbs above 10. Your grandparents bought houses on single incomes with a few years of savings. Today, dual income families struggle to afford a down payment after a decade of saving. The difference is bank-issued money pouring into real estate while paychecks stagnate. Student debt follows the same architecture. Outstanding education loans in America exceed $1.8 trillion. Universities received real money, graduates owe real obligations, yet the loans originated as ledger entries and banks collect interest on them for decades. Then credit cards complete the circle. Average interest rates now exceed 20%. You pay 1/5 of your balance annually on credits that cost the issuer nothing to create. They generated it with keystrokes. You repay it with hours of your actual life, converted to wages, converted to dollars that service debts that come from thin air. Every dollar in your bank account represents someone's obligation to a bank, often yours. You earn wages denominated in debt. You borrow to keep pace with rising costs. You pay interests on balances that never existed as savings. The cycle was engineered to never end. Those closest to the source get the money first. Prices rise. Your income trails behind. You take on more debt to stay afloat, feeding the very system that's drowning you. And it's about to evolve into something far more dangerous. Every hour you work, every dollar you earn, every purchase you make, all of it flows through the system designed to extract wealth from you and transfer it upward. Banks invent the money. They choose who gets it first. They collect interest on numbers that appeared from nowhere. You were never taught this in school. It doesn't appear in the news. The people who benefit have no reason to explain it. And they're not finished. The same institutions are now building the next evolution of the system. A version where they won't just control how money is created, they'll control how you're allowed to spend it. They'll control if you're allowed to spend it. That story is coming next. If this opened your eyes, hit like and subscribe so you don't miss what's ahead. Drop a comment below. What are your thoughts? Click here to watch the next video. What's coming makes everything you just learned look like a warm-up.